Welcome. Thank you for joining this conversation about the 19 rules for getting rich and staying rich despite Wall Street. As we move through this session, as we did with the others, we're going to ask you to go to your book for certain passages. And please have your book available. If you don't own a book, you can buy one at your local bookstore, from our website, uniquereads.com, from Amazon, or wherever ebooks are sold. It comes in hardback, paperback, and ebook format. All right, now let's get started to part one of Rule 18, Equity Investing. All right, go to your book again, this time on page 113. We're going to look at the investment pendulum again. I'm going to take a moment to explain it to you. Again, the top bar is your emotions of fear and greed. And as you can see, it's shaded lighter towards the center and darker the further away from the center you get. The center pole represents the intrinsic value of the investment. The bottom bar holds the same words, fear and greed, and they are again shaded closer to the center and darker the further away from center. This bottom bar represents the market's emotions of fear and greed. The pendulum swings from the market's fear to the market's greed, and the arrow and the dollar sign above the rod of the pendulum ball shows what your emotion should be at that moment in time. So if the market is fearful, you should be greedy. If the market is greedy, you should be fearful. Okay? Now, there's two kinds of risk in equity investing. There are necessary risks that you can't do a thing about, and those are usually company or economy oriented. And then there's unnecessary risk. Some of the unnecessary risk, in our opinion, are currency risks outside of what happens with the multinational corporations that you have, paying egregious overvalue for a company, and three, trying to guess what the future is going to be. You cannot guess the future. No one can. So when someone tells you they know the future, you know that they're not really telling you the truth. You don't want to overpay for anything. And you certainly don't want to take additional currency risk if you don't have to. All right? Now, it's important for you to understand that when you own a stock, you own a piece of an actual corporation that has assets, liabilities, employees, gets revenue, and tries to make a profit. That's what you are. You are an owner of that company. And I want you to think like an owner. These are real businesses. They're not pieces of paper. They're not blips on the screen. They do go up and down every day, but that is really irrelevant to what the company itself is doing, at least in the short term. Remember, no one knows the future. Okay? What you want is you want to buy a good operating business with management that has the confidence and the competency to pay you, the owner, a portion of the profits each year in the form of a dividend. All right? That's it. That's what you want to do. And you want to do it, you want to buy it at a fair price. Wall Street's trading up and down and trying to stroke the emotions of fear and greed. You can use that to your advantage to improve your average annual investment returns, your AAIR, and your average annual total change in your portfolio, your AATC. Okay? Now, we've told you before, and I want to repeat it again. Wall Street's idea of diversification is flawed. First thing they want you to do is they want you to go and buy an index, or they want you to buy an economic sector index. And as you know and I know, inside every index are companies that are not doing well, will never do well, might not even be around for a while. Other companies that are grossly overpriced because those are the darlings of the market, like the FANG stocks, and then before that, the internet stocks, and before that, the Nifty 50 in the 1970s. All right? You want to buy some of those companies in the middle that are trading at a fair price. There's no reason to put your hard-earned money in terrible companies or overpriced companies. All right? Now, the other thing that Wall Street does that I want to remind you that you don't want to do is to take the unnecessary risk of currency, political, and rule of law by buying companies in other countries that you have no idea what those three issues, the currencies, the politics, and the rule of law, are like as far as you, an investor, are concerned. Okay? Now, from here on out, what we're going to talk about is how to build an equity portfolio. In your book is Appendix A on page 145. In that appendix are all of the instructions you need to set up an Excel workbook. Inside that workbook would be a maturity sheet for fixed income, which you can use from building your fixed income portfolio, as we discussed in the last session, as well as spreadsheets for target dividend yields on one, and then one spreadsheet per economic sector. You see, the market is divided into economic sectors. Go to page 121 in your book and you can see all 11 of those sectors. Now I want you to scratch through the real estate sector. Your real estate is your primary residence. In its place, I want you to put the word special situations. All right? Now, on page 122 and 123, I give you suggestions for how many stocks you should look at and follow in each one of the economic sector. Those suggestions add up to 100. Well, you might decide you want to start with just 50. That's fine. But just make sure that you have some stocks you're following in each economic sector. All right? Now, how do you get this? How do you know what's in a sector and how do you know what's in an index? You can either Google or go to your brokerage firm's online research or go directly to some company websites and find out what stocks are in each one of the economic sectors for an index. For instance, I like to use the S&P 500 and the S&P 400. The S&P 500 are big caps. The S&P 400 are mid caps. And I went to the Google and just said, show me all of the companies in the energy sector of the S&P 500. And then after that, the materials right on down the line for each sector. And they'd give me those companies. What I want you to do is I want you to pick out a total of 100 companies or less from those two sectors. And the only criteria I want you to use is that these companies pay a dividend. You don't have to worry about what the amount of the dividend is, what its percentage is, what the price of stock is, or anything else. You just want to have 100 companies that pay a dividend of some sort. All right? Now, what we're going to do here, I want you to go to page 124, and this is where we're going to start. You'll see on page 124, we talk about having an Excel spreadsheet broken down by sectors with 4 columns in it. And you would put in the first column the symbol for that stock. And let's just say you go first to the materials sector, and you put DD for DuPont on the first row, in the first column. In the second column, you put the annual dividend, not quarterly, but annual dividend for DuPont. When you do that, in the third column, a price will come up, and in the fourth column, a price will come up. And what that does is the price in the third column is the price, if you buy the stock at that price, the dividend will equal 3%. In the fourth column, if you buy it at that price, the dividend will equal 4%. And the good part about this particular spreadsheet is that if that dividend changes up or down, it doesn't matter. You plug in the new dividend and those prices will change so that you will be able to see where it yields either 3% or 4%. Okay? Now, this is the first place where you're going to get a sense of companies and their value based upon not only their absolute value, but their relative value to their peers in their sector. All right? Okay, that's it for part one. Part two, we're going to get into the weeds, so to speak, of how you get a good sense of what the absolute value and the relative value is of a company. All right? Thank you for being here. We look forward to seeing you in the next session.